Hey guys, it's Dave Hathaway with another educational episode and interview that I'm very excited to bring you today, where we're going to discuss how you can earn passive income and invest like the wealthy. Brought on a guest that I will introduce here in a second, but I want you to stay throughout the interview as we're not talking about rental property passive income because it's not really passive. We're not talking about REITs. We're not talking about a lot of things that you have heard about, equities, stocks. We're not talking about any of that stuff. So just stick around. We're going to kind of explain it a little bit in depth. But this is going to be ways that you can increase your monthly passive income through investing in syndications. So I brought on Brian Davis. He has a company called Spark Rental. Welcome, Brian. He is contributor to BP Bigger Pockets, if you're not familiar. And he's been an avid investor for 18 years. He's been in online marketing service companies. He is, like I said, owner of Spark Rental. That's why I'm having him on today to share his experience with that. But he also has some other stuff that I actually didn't talk to you before, Brian. He's achieved intentional lifestyle design with overseas travel with his family, partially through investing, partially through digital nomading. Is that right? And can I hand the mic back to you to briefly introduce yourself, Brian?
No, that was a glowing introduction. I appreciate it, David. And thank you so much for having me on the show.
Thank you for being here. Please introduce yourself. Just a brief interview about your journey, how you got here, why you can help people achieve increasing their monthly passive income.
I will try to condense 20 years worth of real estate experience into 20 seconds. I graduated college 20 years ago, had no idea what I wanted to do with my life, fell into a job doing hard money loans for a couple of guys who did hard money loans on the side of their traditional mortgage lending business. And, this is back in like the mid-aughts. Everybody's making money hand over fist in real estate. And so I'm doing loans for these investors, watching them just crushing it. And I'm like, I'm smarter than these guys. Like, I can do this. So I went out and I started buying up properties and renovating them and keeping them as rentals and flipping some. And this is like the worst timing in the world. It was like 2005 to 2008 that I'm going out and just snatching up properties left and right. I bought properties so quickly that I didn't learn from all the mistakes that I was making. It took a little while for those mistakes to become evident. And I already bought a dozen plus properties by the time I figured out that, oh, I'm actually doing this totally wrong. Like, these properties have negative cash flow. I'm upside down on some of these. And then, of course, 2008 hit and the floor fell out underneath all of that stuff. The properties were not performing. My day job disappeared because no one's borrowing hard money loans anymore, right? Had to go out and do a totally different career. Got a job working for an online business that sold legal forms and other services for small landlords, like mom and pop real estate investors, rental property owners. Learned online marketing through them. But, I never would have gotten that job if I hadn't been a landlord myself, if I hadn't been a real estate investor. So, there's always a silver lining to all that stuff if you're willing to go out and find it. So 2016, I left that company, founded Spark Rental with a former colleague of mine. And that has itself been a totally meandering road of different services that we've offered, based on what people have told us our business is. When you go into business, you think you know what your business is, and then the market will actually tell you what your business is. People actually want from you. It's definitely been a story like that. But the main thing that we're doing now that we're super excited about is we run a real estate investment club where members join. We propose new real estate deals every month from professional investors around the world. These are big fractional real estate investment projects like apartment buildings, self-storage facilities, mobile home parks, retail buildings, larger properties. And we just invest fractionally in those. The technical term is real estate syndications. But David, as you pointed out earlier, real estate syndications is a term that a lot of people don't know. They might feel intimidated by. If they have heard of it, oftentimes they have misconceptions about it. These are basically group investments where people can invest fractionally in these large apartment buildings or other large projects.
I love it. Before we dive into what a real estate syndication is, and I didn't actually tell you that I pulled together some statistics that I'm going to throw at you and maybe even have you guess.
Awesome.
I mean, how do you think people right now, the normal person, thinks about retirement investing and income? Do you think they have enough? And how do you think they're investing? Do you think they even know about real estate syndications? I mean, I guess we could call it something else like crowdsourcing or different terms. But how do you think the normal person thinks about retirement? And do you think they have enough money to do their day-to-days.
If you ask the average person about retirement planning, they'll probably tell you about the 4% rule. Never mind that they probably don't understand the 4% rule very well. But yeah, you build up a nest egg, and then you withdraw a certain amount every year and hope that you don't run out. And by the way, the 4% rule was calculated based on a 30-year retirement. I personally, I want to reach financial independence and at least have the option of retiring way earlier than my 60s. I'm 42 now. We hope to be financially independent within the next few years. And to do that, you can't spend down your nest egg over time, right? Now there's math that if you lower that withdrawal rate to 3.5%, maybe a little bit lower than 3.5%, technically, or at least based on most historical models, you shouldn't run out of money ever. Your nest egg should keep growing indefinitely because your investments should keep growing faster than that 3.5% withdrawal rate. But I still don't love that either.
4% rule. Can you just explain it just briefly? 4.5% rule, because I actually don't know what it is. Shamefully, is it just drawing down your nest egg 4%? The assumption is that you have $1 million or?
Yeah. So the 4% rule, this was introduced back in the 90s by a financial planner named Bill Bengen. He looked at all of the historical returns on stocks and bonds for the last, I don't know what it was at the time, like 80 years, 100 years. And he basically said that if you, in the first year of retirement, if you withdraw 4% of your nest egg, and then each year after that, only adjust upward by inflation. So not 4% of your current nest egg each year, but 4% of your nest egg in the first year, and then just adjusting your withdrawals each year thereafter by the inflation amount. Then by all of the scenarios in the past century, it was something like a 99% chance of your nest egg lasting at least 30 years.
Gotcha.
So, you're basically safe doing that and not running out of money before you die. But, to your point a moment ago about, $1 million, 4% of $1 million is $40,000 a year, right? That's not a lot of money to live on. But $1 million is a lot of money to save up. So, you're talking about a lot of work to build up this big nest egg and not a lot of income from it over the next 30 years or more.
If you're interested in lifestyle, I'm going to give you those statistics that I pulled before this, courtesy of Bard. And the statistics were at retirement age 65, and this is by the Federal Reserve, the average household in the US has $426,000. And then in addition to that, the average retirement Social Security income, this is today, is $1,827 per month. Kind of just gives you, if you're planning for a lifestyle, which listening to some of your interviews, and I want you to just briefly touch on this because I think it might hit home with some people. I don't travel outside the US too often. I know you have traveled, and you can correct me if I'm wrong, outside the US, but not just for work. You traveled with your family and traveled abroad. Can you just briefly hit on that? And if that was, I'm assuming it was by lifestyle design, but please correct me if I'm wrong. If you're like, no, this is just out of, I had to do this, or you have family there, just briefly hit on why you decided, hey, I think it's important for my family to get exposed culturally to different cultures.
Yeah, so we are expats, actually. We live overseas, and we have lived overseas for over 8 years now. We moved to Abu Dhabi in the UAE back in 2015.
Okay.
And we've been abroad ever since. We spent years in Abu Dhabi. The next 4 years we spent in Brasilia, the capital of Brazil. We just moved to Lima, Peru a couple months ago.
Awesome.
And the way that came about, I always loved travel and international travel. My wife saw that I had some wanderlust and wanted to get out ahead of that. So she's a school counselor, both at the time and today. She reached out to a friend of ours who is an international teacher and asked, how she found her job, what's the process like to get hired by international schools. So this was unbeknownst to me. She went out and started inquiring about this, signed up for a recruiting agency for international educators, and booked a trip for the two of us to a job fair for international recruiting, and then told me about it. And she was like, hey, so this is what I did. We're going to Boston in this weekend in February, and I'm gonna get a job overseas. And I was like, Wow. Okay. Awesome.
She came in like a wrecking ball.
Exactly.
No, that's awesome. And then you have kids for context, or you do not have kids?
3-year-old daughter. She was born in Brazil. She's a Brazilian citizen. She has dual citizenship, has 2 passports, and will for life. Which is great. I love that.
That's awesome. And you guys have decided that that is your path. And it's super interesting because I know very few that do this. So this is your path going forward. You and your wife and daughter, have you guys decided you're going to come back to the States at some point? Do you visit, or are you like, hey, we just do like 4-year stint rotations to get this crazy cultural influence because we think it's amazing for our daughter, or maybe we just love the adventure? I mean, what's driving that?
Oh, so many things.
Sorry, I know it's a loaded
so
kind
many things. So we aim to come back to the U.S. for a month and a half, 2 months a year. We try to come back every summer and every Christmas just to spend time with our families and our friends back home. We're very close with our families, unlike a lot of the people who live this lifestyle. I mean, it's best to spend a lot of time in the U.S. So we try to spend around 2 months a year in the U.S. with our families. We do a lot of international travel, of course. The reason, or the many reasons that we like this lifestyle. First of all, we get to live a pretty comfortable lifestyle entirely on my wife's salary and benefits. And that's not because she gets paid so much. I mean, her salary is pretty comparable to a US school counselor salary, which is comparable to a teacher's salary.
Yeah.
In fact, she probably gets paid a little less than the average salary in the US, but she gets amazing benefits. We get free housing and nice housing. I mean, our apartment here in Lima, it's on the 13th floor of an apartment building overlooking the Pacific Ocean. I mean, we have a balcony with an 180-degree view of the Pacific Ocean and the coastline. I mean, it's amazing.
Yeah.
And the rent, if we were to pay for that rent ourselves, the rent's $1,300 a month. And we don't pay for that. We get it for free, basically. But so free housing, full health coverage for our entire family, paid flights home to the US every year, free tuition for our daughter at some of the best schools in the world, IB, International Baccalaureate schools. It's an extremely rigorous curriculum.
And that's paid for, just out of curiosity, that's paid for by the US government, or is it paid for by the governments that are bringing her in to be a counselor in like Abu Dhabi and Lima? It's paid for by the local governments to have her?
It's an employment benefit, so it's technically paid for by her employer. But the school where she works now and the school where she works before that were U.S. Embassy schools. Mm-hmm. So the Foreign Service in the U.S. has a contract with the schools to pay a certain amount of money per student, and it's a employment perk.
Cool.
It's the free tuition.
Sorry for massively sidetracking you. I think it's a very interesting story. I think a lot of people, don't even think about these things. A lot of times we have epiphanies in life where it's like, I didn't even know there's an option. I have these epiphanies but especially with other parents, people that have kids are like, oh, you guys do what? I didn't even realize that was an option. And it's like, and then you're like, oh, we can do X and Y and Z, and everybody's got different style. And where do you call home, just for the viewers? Is it Baltimore? Is it Maryland, or is it somewhere else in the U.S.?
Yeah, I mean, most of my family still lives around Baltimore. So, okay. Yeah, I mean, Katie's family is a little bit more dispersed around the country. But yeah, I consider Baltimore my hometown. As far as lifestyle design and what we're doing, we get to save and invest a ton of money because we're living overseas, because the cost of living where we are is so much lower than the U.S., because my wife's benefits are so much better than the U.S. So we aim to live entirely on my wife's salary and benefits. We aim to save and invest all of my income. And because we are doing this, because we're overseas, and because we can live a pretty comfortable lifestyle just on my wife's income and benefits, that frees me to take some more risks in both my career and in my investments. It freed me up to start an online business, for example, where there's no floor, right? There's no security floor on that income, but there's also no ceiling on that income. It frees me to invest in things like real estate syndications, which target, 15 to 30% annualized return. And in fact, I invest in real estate in lieu of bonds in my portfolio. I still invest in stocks heavily, but we have almost no bonds in our portfolio. It's mostly real estate investments of some kind or another that fill that same role or purpose in our portfolio as bonds do for the average person, but earning much higher returns than bonds pay. So that all kind of plays together in that lifestyle design. It frees us up to take more risks, earn some higher returns, pursue some higher business revenue, which is, it's all kind of part and parcel. It forms this kind of virtuous cycle in our personal finances.
I also want to just set some foundations here of passive versus active income, or I'll call it earned income. Basically, what your wife makes is earned income. Can you just share with us the difference between passive and active income, and maybe just a little bit about maybe tax implications on both?
Income. You had asked about passive versus active income.
Yeah.
So, active income or earned income, W-2 income or business income, if you are still actively involved in the business, which of course I am with Spark Rental, it's very much a full-time thing for me. That's active income because you're going in to work every day and working at it. Even though I can work from in the world, I have a co-working space where I go every day and get out of the house. So I'm there for 10 hours a day working, but that's all active income, right? The income that I earn on my real estate investments is all passive income. It's income that comes in without me having to work for it. Same thing with like dividends from stocks, right? Or interest from bonds. These are all forms of passive income from your investments. And to me, what gets interesting about that is you can compound those in sometimes creative ways. So there's this concept that we talk about a lot called infinite returns in real estate. You can earn infinite returns on either rental properties or on real estate syndications. And the idea is you go out and I'll use the rental property example just because it's simpler to understand. You use a strategy called the BRRRR strategy. It's buy, renovate, rent, refinance, repeat. And it's like flipping a house, but instead of selling the house at the end of it, you refinance it and keep it as a rental. But when you refinance it, you pull your initial investment back out of it because the refinance, the value is based on the after repair value as opposed to we paid for it. So if you grow the value enough, if you force enough equity and pull your initial investment back out, you now have $0 tied up in that property. You can go out and recycle the same down payment and closing costs capital in new properties. Theoretically, you could take the same $50,000 and just recycle it over and over again and build a portfolio of 20, 30, 40 properties and then retire and your nest egg would technically be $50,000, right? The same principle, the same concept applies with real estate syndications on a bit of a slower time scale, but same concept. A lot of these deals, these large like multifamily deals or other types of properties that you invested in syndications, the sponsor, who's the primary investor, like the professional investor who's responsible for the deal, they'll go out and they'll do kind of like a glorified flip or the same concept with a big multifamily property. Uh-huh. So say that they buy a 200-unit apartment complex. They spend the next 18 months renovating it and raising the rents after the renovations. They create equity in that property. They raise the value because they've raised the rents. And then they go out and they refinance it and get all of that initial equity capital that people like you and me invested in. They pull that back out and give it back to us, but we keep our ownership interest in the property. We keep collecting cash flow and distributions from that property indefinitely. But we got our original investment back. We can go out and keep reinvesting that in new rental properties, new real estate syndications, stocks, whatever. And again, you recycle the same investment capital over and over and over. Keep earning passive income on each one of those as you add them. So you start stacking up these streams of passive income from many different properties, which you may not have had to invest more and more money in. You may be able to just use the same money to invest in those. So, in the real world, it doesn't always work out like that. If you use the BRRRR method, often you can't pull every penny that you invested back out of the property. In a real estate syndication deal, maybe they don't give you all of your investment capital back on that refinance. Maybe you get 70% of it back or 75% of it back or whatever, and then you get more later when the property sells or when they refinance it again or whatever. So the real world is a little messier.
You're talking about if you're doing a perfect strategy, that's what you want. You want to do BRRRR perfectly and refinance all of your money out, and still the property cash flows, still the property appreciates. Still,
Right.
your
In a
tenant
perfect world.
doesn't, their the stove on fire and it cause an insurance thing. In the perfect world, appreciate everything you shared right there. It's all super powerful stuff. I want to dive in a little bit more about Spark Rental itself and how it works. Can you kind of give us kind of a picture of how it works, kind of your day-to-days? What would someone expect?
Yeah. So the main challenge, there's a couple big challenges with investing in real estate syndications. One of them is that there's a very high minimum investment typically on these deals. These have historically been what are referred to as country club deals. They're for wealthy people. They're often word of mouth. The high minimum investment for these is usually in the $50,000 to $100,000 range. Obviously, a lot of money. It's kind of comparable to a rental property, right? Between the down payment, closing costs, any repair costs you need to do. It's a lot to tie up in a single asset, right? It makes it hard to diversify within your real estate investments. The other challenge with syndications is that the ones that do allow non-accredited investors, people who don't have $1 million net worth or at least $200,000 of income every year, it's hard for them to find syndicators or sponsors who allow non-accredited investors because the SEC doesn't let them advertise to the public. They don't let them market these deals to the general public. So if you are a middle-class person or someone who is not yet an accredited investor, how do you find those syndicators, right? Because they can't market to you. They can't advertise to you. Our investment club solves both of those problems for investors who want to invest in real estate but who don't want to become landlords. Every month, we propose a new deal,
Great.
sometimes several deals, real estate syndication deals that allow non-accredited investors. That's a core value of our club, is inclusiveness, having every deal be available to everybody, not just wealthy investors. And investors who want to participate in that deal can do so for a minimum of $5,000 per deal. Now, that might seem like a lot, and I'm not trying to trivialize that, but it's a lot less than $50,000 or $100,000 that you would normally need.
So I love what you did there with, hey, this is the problem, and Spark Rental is the solution to that problem. I'm just going to share my own experience real quick, and I kind of want to back up just a little bit and delineate between sophisticated and accredited investors. Most real estate syndications, and most people haven't heard about this. That's why I kind of built that framework at the foundation of what we talked about at the start. Now, there's just not a lot of education out there, and it's not super mainstream when you talk about country club deals. You're talking about high net worth individuals that are investing in these things. And so normally you have to be an accredited investor. So an accredited investor, you have to either earn $200,000 in the last
For singles,
for
$300,000 for married couples. Yeah.
2 years. And you have to have you're going to make $200,000 in the future. So you can't be like bumping up next to retirement. Or for married couples, you have to earn together $300,000, same thing in the past 2 years. And you have to anticipate that you're going to earn it in the future. And this is why I was super bummed out when I started investing in syndications a year and a half ago. I just couldn't share it with anybody because either there's a couple way you're accredited. Either you own a ton of real estate already. It was me. I own a ton of real estate on 50-unit portfolio. So, and that bumped our net worth up above $1 million. Sorry, we missed one big thing in there. The net worth includes your personal residence. Probably most people's net worth currently is their personal residence. So you have to exclude your personal residence.
Yeah. Yeah. You can either qualify based on income or you can qualify based on net worth.
Correct.
And you're right. Your net worth has to be at least $1 million, not in equity in your primary residence.
And why I was so bummed is because I was thinking about it. And this is why I was super excited to meet you and to join the club. And so everybody knows, part of Spark Rental Investing Club. I was super bummed because the way I felt like people could be accredited is they owned a ton of rentals, and that took a decent amount of time. I mean, my journey took 14, 15 years. Or you owned your own business. I mean, business owners usually can gain wealth pretty quickly. So like a franchise, or you started your own business and it's doing well. We're not talking about a small business because it's hard to get wealthy off a small business. Or you're older, which is, you're getting close to retirement age and you have $1 million or 1.5 or 2 million that is in the stock market, invested in the stock market. And I was like, dang, I can't even have these conversations with, a 30-year-old that it just doesn't hit. They'll be like, well, that doesn't make any sense. So I was like super excited that Spark Rental solves that problem. And that was one of the reasons why I want to interview you to chat about, hey, you don't have to be accredited to get access to this stuff. Can you walk me through the difference? what's a sophisticated investor, and how does Spark Rental get around that? And I don't want to say it in a bad way, get around it, but how did you solve for that problem? And I did want to hit the last is that when you said most syndications have a minimum, the majority of them probably have a minimum of 100K. So you have to have 100K liquid, and it's not like you can leverage it like in real estate where you put in $10,000 and you control $150,000. This is you put in $100,000 that's straight out of your bank account. So if you don't got it, you're not in, which is hard to do. And Spark Rental solves for that problem.
Absolutely. So the SEC, they offer sponsors, syndicators, a couple different options for how to classify their deals when they're raising money for them. One of them is a regulation 506C, which gives them a lot more flexibility to advertise to the public and more flexibility in general, but it restricts them to only allowing accredited investors to participate, right? Like what we just talked about. The other classification, or one of the other main classifications, is 506B, which allows up to 35, what the SEC calls sophisticated investors, who are non-accredited investors. They don't meet that definition to be an accredited investor, but the SEC, they require them to have some knowledge of what they're investing in. So that's part of why education remains, to this day, a huge part of what we do at Spark Rental. We publish new articles every week. We hold at least monthly meetings in our co-investing club, often more than monthly. We do webinars and free classes. We have a weekly podcast. So we want all of our members to be extremely educated about exactly what they're investing in when they participate in these. What are the risks? What are the returns? How do you analyze those? Because there are risks, right? There are risks in every investment. I don't necessarily think that the risks in real estate and syndications are higher than the stock market, even though the returns are typically higher. We aim for deals that pay in the 15 to 30% return range. So people will ask us, well, then, hey, isn't the risk very, very high as well? To which we say, well, there is risk. And maybe some of these deals do have high risk, but the reason why they can pay returns that are so much higher than that average 8 to 10% stock market return is there are some inconveniences that come with these real estate syndications that don't come with stock investments. So those inconveniences, like the high minimum investment, the requirement to be an accredited investor for a lot of these, like the lack of liquidity, those inconveniences are what dictate those higher returns. There are not necessarily proportionally higher risk compared to that higher returns, but there are inconveniences and downsides. You need to be aware of all of these things before you invest.
Can we compare an analogy almost like investing in a luxury good versus investing in kind of a basic good where, hey, you can get higher returns? It's not necessarily that there's more, kind of seems like that. It's almost like you get to invest in a luxury good because it's a higher barrier of entry compared to a lower barrier entry with lower returns, where anybody can buy an ETF, even like a partial ETF where you're not even purchasing a share of stock. Maybe the share of stock is $50, but you can just put it in $1. I mean, that's easy. The returns are going to be in turn the same thing. Hey, if there's so much accessibility, but if you have to put in $100,000, okay, you're going to get a higher return because it's harder. There's not as many people that you can really, so it's more of a luxury good over just a commodity, if you will.
Yeah, no, that's a fair way of looking at it. And, sometimes people ask me, how do real estate syndications compare to publicly traded REITs, right? Because the classic way that people invested in real estate passively was these publicly traded real estate investment trusts. If you look at the performance of REITs over the last 50 years, their average performance is somewhat comparable to the stock market at large. So it's not the average returns are bad. The problem with REITs is volatility and correlation to the stock market. A huge part of the point of investing in real estate is diversification away from your stock holdings, right? I mean, that's what we're doing here. The stock market is very volatile because it's so liquid. When you can buy and sell on a dime, that creates volatility. That volatility applies to REITs as well. Yes, they're liquid, but that creates volatility. But they're too closely correlated with stocks. There was a Morningstar report that was out, I don't know, a year or so ago, analyzing the last 2 decades or so of publicly traded REITs in the US versus public stock markets. And the correlation was 0.59. And a correlation of 1 is a perfect lockstep correlation. Correlation of 0 means no correlation whatsoever. So a 0.59 is actually pretty high correlation and to a lot of other subsectors of the stock market. You don't get that diversification benefit if you invest in REITs, but you do get liquidity, right? So I'm not trying to tear down REITs here.
i.e. when like the stock market crash of 2008 happened, everything gets sold out. And a lot of it's just because everything's bundled together. So there's a lot of ETFs and mutual funds that have all the holdings. So if you sell out of that ETF or mutual fund, everything gets sold off. And that's why real estate's a little bit different, because it's localized, giving the advice to other people of like, hey, what's going to happen to my house, Dave? Like, where is the house? I mean, it's so localized where you can't just say, hey, the house is going to drop all of a sudden $100,000. It doesn't work like that. You can have sub-markets and micro markets, and they're all changing. You can have like a Houston, Texas, or a Florida where everybody's moving to. And then you can have some markets like California, New York, where people are moving out of. And if you're in the right markets, it's going up, and you're not going to get that crash. It's not unless the government all of a sudden changes some massive laws that affect all real estate the same, like take away tax depreciation or take away some other things. And that's what you're talking about, right?
Yeah, and I know statistics. So here's a couple statistics for you. 2022, last year, the S&P 500 dropped, or it had a total return of negative 18.1%. Average U.S. publicly traded REITs had a total return of negative 25.1%. But the average home price over 10%, and that doesn't even take into account income, which the other two stats were including income in those returns. So there's that disconnect between, REITs are moving like stocks, even if the fundamentals in the real estate market are okay. And I'm not trying to say that they were okay in 2022 necessarily, but they certainly didn't drop by 25%. So
that's a great statistic. I love that you shared that. I would assume that most of those REITs are probably commercial grade assets, i.e. office buildings, i.e. strip centers, and not very many are correlated with like single family, like REITs of single family. I'm sure there are, but I would assume it's heavy weight in commercial. No?
Well, it's all commercial, but commercial is not just office space, right? I mean, a lot of people kind of conflate commercial real estate and office real estate, but commercial real estate includes apartment complexes. It includes, storage facilities and industrial properties and retail properties, and of course office properties, and restaurant, and I mean, all kinds of and hospitality, hotels. It includes all of that stuff.
Briefly finish up with sophisticated investors. You said it's required for them to have a bit of knowledge, and you guys provide some of that knowledge at Spark Rental. What classifies like I can be a sophisticated investor as knowledge? And it's probably massive gray area would be my assumption, but they
total
don't
gray area.
Total gray area. It just says, hey, kind of, you can be a sophisticated investor if you've looked at some sort of knowledge of the asset, or have you own your own house. You could kind of make up whatever you wanted as far as education wise.
Yeah. I mean, we want all of our members to be as educated and as informed and as sophisticated as they possibly can be. It's why we provide so much education to them. But it's not like we give them a test and say, you have to score above 80% on this test in order to invest. We just expect that they are learning as much as they can, and participating when we have group discussions as a club. We bring on the sponsor and we grill them together as a club. We bring them onto a group video call. We all discuss the deal together. But yeah, there's not like a litmus test for what determines a sophisticated investor.
To go even further, I mean, with these syndications and operators, can you give me some examples of like what's a deal that an investor in the club could invest in? Give us some like examples. What does that look like?
Yeah, so the kind of bread and butter of the deals that we look at are value add multifamily deals. So a sponsor, and again, a sponsor just refers to the lead investor on a deal. You could call it the GP, the general partner, or the syndicator. I'm
glad you're sharing all those. It's important.
Like you talked about earlier, most people aren't familiar with syndications, and they do have their own kind of lingo. So I want to make sure we're not leaving anyone behind here with the lingo. But
no, I love it.
So sponsor funds a multifamily property, let's say a 200 unit apartment complex in Dallas that is run down, has a lot of deferred maintenance. It's in a good area, but it's like the worst apartment complex in that area. They go in, they buy the property for a pretty cheap price, relatively. I mean, still millions of dollars, right? But cheap relative to other properties in the area. And then they do like a flip, basically, where they totally renovate the interior of every unit. They update all the common areas. Maybe they've put a shiny new sign out front. they turn it into a much better place to live. And then, of course, they raise the rents accordingly because they've improved the property so much. Properties like this are priced based on their income, right? Their net operating income. So that raises the value of the property. And after they finish this process of renovating the property, stabilizing the rents, they go out and either sell it for a nice profit, and that profit gets distributed to all of us, or they refinance it and keep it for the cash flow for a little while, let it keep appreciating in value, let those rents keep going up. So that's kind of a classic deal. You do get some income for the typical deal while you're waiting for it to refinance or sell.
When do they come to the club? Pre them purchasing that property that needs all those improvements? Or is that after they purchased it? What are they seeking from the club? How does Spark Rental help those sponsors and operators? And again, sponsors, operators, GPs, all we're talking about here is just the person that's finding the deal. That's the lead operator that's bringing this big multifamily that needs money, usually, to finish out their plan. When do they bring that to Spark Rental to say, hey, I'd like to share this deal with you guys? When does that happen?
It's normally by the property. It can be afterwards. We have invested in some deals where the sponsor already owned the property. They're already operating it, but maybe they didn't raise quite as much money as they were planning when they first bought it. Maybe they're expanding the property, adding new units and need more capital for that. But typically they're raising money in order to buy the property. So they go out and they borrow a certain amount in a loan, typically in that 50 to 75% range of the cost of the property. And then they have some money themselves that they're putting in a down payment, but not $10 million, right? I mean, they don't have that kind of money. So they raise the rest of it from passive investors like you and me, people who are called LPs or limited partners who are investing completely passively. That entitles us to a share of the profits, both the cash flow while it's owned and profits upon sale.
That all depends on how they structure it. They're just bringing their plan. So they find this property, and I just want people to understand it because this is very, very far out for most people, especially just your traditional 401kers. Not that we'd say, hey, it's a terrible thing, but for those people, they are going to have the operator, the sponsor, come pitch the deal. They basically give you the plan. Here's what we're going to do with the property. We're going to renovate the units. We're going to do all this stuff with the capital that you invest in this deal. And then we're also going to either pay you quarterly rents. We're going to pay you on the back end. And we won't get in the intricacies. I don't think that's necessary we can kind of get into what the overall returns look like, but I don't want to get into the splits and, hey, we're going to pay you a certain amount of rents or this and that. I think that's over the top because that's very deal specific too and can be very liquid. So for the average person watching this, how can we know that we're not going to put in $5,000 to Spark Rental and that operator is just going to go, hey, this is not going to work out. I'm walking away, and I just never get the money back. That would probably be one person's concern of just say, it's never going to come back to me. I'm never going to see that money again.
Yeah, there's risk in every deal. No question. And, it's important to understand that risk. We like to think that the risk of the sponsor just taking everyone's money and running off to a third world country, we like to think that risk is pretty low because, we do look at the sponsor's track record, right? We want to invest with people who have been doing this for a long time, have established a good track record of success. They're established within the industry. So, the odds of them just taking the money and running to a beach somewhere are pretty low. But there are other risks that are inevitable in any kind of investment. Rising interest rates have been a big challenge for a lot of real estate syndicators over the last year and a half. Rising cap rates reduce the profit upon sale. It makes it more of a buyer's market than a seller's market. If you bought a property or if you bought into a syndication 2 years ago, you would not be in a fantastic position today necessarily. If you buy it's more of a buyer's market at this exact moment. Hopefully people who are buying in now are getting a pretty good deal and will be sitting pretty in 2 years from now. But you can't time the market, right? And we don't try to time the market. That's part of what we're doing in our club is just dollar cost averaging. We invest every single month, different deals in different cities, different states with different sponsors, different types of property, mobile home parks, in retail, industrial, self-storage, multifamily.
Is one of those things that de-risks this investment So we're talking about investing money. Is one of the things that de-risks it is that these syndications are regulated by the SEC, or no? Does that not de-risk anything?
I mean, sure, it probably reduces a little bit of risk, but you still need to do your due diligence on the deal. Make sure that you're comfortable underwriting assumptions. What kind of cap rate are they assuming when they're projecting 20% annualized returns, right? Are they assuming a really low exit cap rate, which is very optimistic, or are they being more conservative and using a higher exit cap rate? What kind of rent growth are they projecting?
Yeah,
Is it reasonable?
Just so viewers can be on the same page, and I'm sorry to just interrupt you. Cap rate, let's just briefly talk about, I think it's important to share how you can value these assets and why they're kind of unique from equities. And if you just don't mind sharing cap rates and what that means, but how it relates to how much income an investment makes, or the NOI, the net operating income, and how that relates to the cap rate.
Yeah. So divided by the cap rate gives you the valuation of a property. So the higher the exit cap rate, the lower your return as a seller, and the bargain you're getting as a buyer.
And in super layman's terms, it just means people are willing to pay for the amount of cash an asset spins off. Doesn't matter what it is, right? Am I right? Or yeah. Doesn't matter what it is, as long as it's spinning off a certain amount of cash. If you think about each property almost as a business, and you say, that property makes $1 million a year, how much are you willing to pay for that $1 million? And that's how people think of how much to pay for a commercial property or for a syndication. Am I correct?
That's right. The lower the cap rate, the more a buyer is willing to pay for the same amount of cash flow, basically. The higher the cap rate, the less the buyer is willing to pay for that same amount of annual cash flow.
Are syndications any type of properties? Can they be single family or multifamily only? Are they storage units? Can they be a mix of everything?
Really any type of commercial real estate, storage, mobile home parks, multifamily properties, retail, industrial, all of those are fair game. There could even be funds that own a whole bunch of single family homes. Haven't seen a lot of those. See more of that in like real estate crowdfunding.
And I know you're going over risks, but as far as risks, how does Spark Rental kind of mitigate those risks?
Well, we vet these deals as a club. So to be very clear, we are not vetting these on behalf of you. Vet these together as an investment club. So we bring the sponsor on and we all grill them together to ask them questions about risk, returns, what they're doing to mitigate those risks. So it's group vetting of these deals and analysis of the deals.
Anyone can invest?
Yeah, any club members can invest in any deals. They're purely optional.
And the only requirement is that you put $5,000 in the investment per person.
If you are participating, the minimum investment is $5,000 per person.
But you can go up as much as you want. If you want to invest more, you're like, oh man, I really like this investment. It has a really good return.
Yeah, you can invest as much as you want in almost all deals. There are a couple exceptions.
And you chatted about brief returns. You said you can expect somewhere between 15 to 30%. I mean, 30% sounds crazy. It sounds like, man, I get nervous when investments are really like returns show really high. Where do you come up with those investment returns or those assumptions?
That's based on historical returns from this who we've invested with. I mean, there's a sponsor we've invested with whose average annualized return that they've delivered to their investors is over 70%. It's like 70.5%. It's crazy high. And I don't expect that to be the case moving forward. But yeah, these are based on actual results from real sponsors who we've invested with.
I mean, how do they just share those results, or are those results regulated as well? Or is they like cherry pick? I know I have some properties that have crazy returns and other ones that don't. And I could just cherry pick and be like, hey, I got this property that's got infinite returns. I don't even know how to calculate it because it's a burr and it makes, $20,000 a year and I don't have any money in it.
No, these are the average returns across all of the properties that have gone full cycle and sold.
Okay. That's awesome. Yeah. Hey guys, before we wrap up this interview, after we finished, I asked Brian if he'd give our listeners a discount to join the co-investing club over at Spark Rental, which he graciously said yes. If you go down in the description of the video, there is a discount code for 15% off. So thank you, Brian, for that. We also had a brief conversation about what his big learning lessons were or takeaways from investing in syndication, which I thought was extremely insightful, and I wanted to add it on here. And it basically was that he had renewed appreciation for his time. When you invest in rental properties, you're dealing with contractors, you're dealing with lenders, you're dealing with leasing agents, property managers, you're dealing with everything. And so it becomes much more hands-on. And then when you're dealing in syndications, he mentioned he just had a great appreciation for passive cash flow where he'd invest money and then receive distributions. I thought that was just a great takeaway from him for his big learning lessons from investing in syndications. So I'll let you guys get back to the interview. Thank you again for listening all the way through the interview. And, hopefully you got some value out of it. All right, guys, we've kind of gotten an overview of what Spark Rentals has to offer as far as a investing club that you don't have to be an accredited investor. I really appreciate your time, Brian, and we'll wrap this up. As far as if anybody's interested in Spark Rentals as investing in the club, and we'll list it in the description, but what's your best contact they can reach out to you if they're interested in just learning more about the club?
Sure. Yeah. Come to sparkrental.com. You'll see our co-investing club listed right there front and center. You can reach out to me personally at brian@sparkrental.com. You can reach us at support@sparkrental.com or hit us up on social media. You can find us on all the typical channels. We have a huge Facebook group of 46,000 plus real estate investors. So yeah, come reach out, connect with us.
Awesome. Well, thank you again, Brian, for your time. I really appreciate it. Hey guys, if you haven't already done so, please like and subscribe to the channel. And again, if you have any comments, feel free to put them out and reach out to Brian, or feel free to put them on the comments below. See you guys.
David, thank you so much for having me.
Thank you, Brian. Appreciate it.